Hi, I'm Ric Edelman, and this is The Truth About Money. Coming up on today's show, the more elaborate you're planning your funeral to be, the more important it is that you pay for it in advance.
What's love? What a lot of cynics would say, it's what you do in the back seats of a car when you're 18.
What advice would you give a couple nearing retirement in a underwater mortgage?
That, by the way, has been one of the biggest frauds of American politics, is tricking people into thinking that the American dream is homeownership. And that is what has caused the mess that so many Americans are now in. That's all coming up right here, right now, on The Truth About Money. Do you have a child or grandchild headed to college? Well, what are you doing to help save for it? Let's find out what folks in the street say that they're doing for college planning.
Hope and luck, and having a job in high school helps, and just being really frugal.
The best way to save for college would be a 529 plan.
At this point, we're rolling things into a Roth IRA.
We had some funding set aside for it, but we pay as we go. They're in state schools, so we're able to pull that off. But yeah, we did set around some money in a 529.
I have every month like $10 each kid in a bank.
Don't get a bad loan. Saving for college would mean, yeah.
No wonder we're getting so many different responses. College is increasingly expensive, and that's making it downright scary. In fact, the average cost of an in-state school for tuition, room, and board is now almost $17,000 a year, and costs have been doubling about every 4 years. That means the child's senior year will cost twice as much as their freshman year. Yeah, you need to start saving. And the best way to do that is with a Section 529 college savings plan. With a 529 plan, all the money grows completely tax-free, and you never pay taxes on withdrawals when you use the money to pay for college. You can open a 529 plan with just $25, and you can put in pretty much as much money as you want, hundreds of thousands of dollars if you feel like it. Second, you can use the money for almost all college expenses, including tuition, room and board, computers, even books, pretty much everything except travel. And you can use the money at any accredited college, even for graduate school. And if your child ends up not needing the money, no problem. You can use the money for other kids in the family, siblings, even cousins. You can even use the money for yourself. And there's no age or time limit for using the money either, so it can grow tax-free literally for decades. And once you open an account, anyone can contribute to it, including the grandparents. TV's fun, but what I really love doing are seminars. Here's some Q&A from a recent event.
I have a question. In the mail, I've been getting a lot of advertisements about prepaid funerals. So what I'm wondering is, what would be better? I don't want my kids to have a burden of not being able to bury me like I really want to be buried, which is not your average type. But what I'd like to know is it better for me to prepay a funeral because funeral, they can go out of business, or just to have a lot of life insurance, which if I have to go into a nursing home, as I understand it, they take that.
The more elaborate you're planning your funeral to be, the more important it is that you pay for it in advance. For the simple reason that I would not rely on my children to do what it is you want to have done. Yeah. I would also encourage you, in addition to prepaying for the funeral, you have the funeral before you die so that you can go and enjoy the party too. It sounds like a great shindig that you're putting together. Prepaying a funeral is very, very common, and about 30% of all adult Americans over the age of 55 have prepaid for their funeral. It makes a great deal of sense, not only economically, but also the fact that you're sparing your children the trauma of having to make extraordinarily difficult decisions at a period of extreme grief. And we all have heard horror stories, if only anecdotally, of people who have been abused financially, tricked into or coerced into spending more money from funeral homes or funeral directors than people would like. The vast majority of funeral homes and their directors are honest, hardworking, ethical people, but let's face it, you've never bought a casket before, and the one time you're faced with that decision is when you are under extreme emotional difficulty. This can all be eliminated by prepaying for the funeral. So we do encourage people to do this as a routine part of estate planning, and again, make sure that you're having a conversation with your children, because they're going to be the ones to execute that plan in its ultimate time. And most importantly, if you don't tell the children that you have done this, chances are they'll go out and spend the money all over again. If they don't know that you chose a burial site, and that you have purchased the casket and hired the band and the caterer, then chances are they're going to go spend that money again anyway. So it's very important that you do this and that you tell your children about it and get their buy-in for it so that you can be certain that your final wishes are indeed followed. And it is not morbid, it is not a necessarily difficult conversation. One of the most famous funerals that we've had in this country in the recent past was Ronald Reagan's. And reportedly, he designed his own funeral and produced a document that was over 300 pages long that outlined in minute detail everything that he wanted to occur with his funeral. And I think all of us who remember that day were in awe at how lovely it was. It did not appear ostentatious at all, and was very suitable and appropriate for a man of his stature. And you deserve to do that for yourself.
Thank you.
Sure.
Hi, Rick. My name is Janet Watucky. I'm currently working full-time, but I'm starting a home-based business in my spare time. I was wondering what advice you might have for me.
Describe your business.
It's a wellness coaching business, so a form of life coaching.
The good news about your business is that it doesn't require inventory, which dramatically simplifies the nature of your business, which is terrific. Is this the coaching techniques, are they yours, or are these that you have licensed from others?
I've taken courses and, yeah, licensed from others.
So you'll be licensing this, or is this a franchise business that you're establishing?
Nope.
Okay.
No.
Do you have a license agreement with the folks?
Yes.
Okay, so do you have to pay them a piece of the revenue?
Yes,
that
for
you
part
earn?
of the testing that I use, yes.
Okay. What you need to do is two things. Most entrepreneurs fail to understand this premise. There are two elements to running your business. The first one is developing the knowledge and expertise in order to deliver the service or product that you're working on, and you're working on that very, very intently. But there's another piece as well that many entrepreneurs ignore, and that is the marketing communications element of it. It doesn't matter that you're the greatest widget maker in the world if nobody knows that.
Right.
So what you need to do is spend time learning how to market your practice and to get the word out through most commonly network marketing or referral marketing so that you can build the clientele you're looking for. Most of the folks in the type of consulting you're describing do not have an awful lot of repeat business because people go through your program, their lives get improved as they want, and they're done, unlike a physician who will have patients annually forever, for example. So you need to recognize that the key to your business success is a constant influx of new business, managing the current business, but generating the new business to come in after that. So referral marketing and network marketing is going to be a key element to helping you generate the business to enable you to be a successful entrepreneur. So as you're developing your skills and expertise in being the expert that you need to be, make sure that you build an equal level of skill set on the marketing and communications front. And if you don't have the time or the knowledge or the desire to develop that skill set because it has nothing to do with widgets, which is your passion, that means you need to hire an advertising or marketing or public relations firm to do those things for you, rather than not doing them at all or doing them yourself and doing them poorly. So in other words, you have to be an expert at the business of business, which is totally different from the field that you're dealing with.
Yeah. Thank you.
Sure. Let's see how much you know about personal finance. Here's our Truth About Money quiz of the day.
Of today's 65-year-olds, how many will require long-term care at some point? 10%, 25%, 40%, or 50%?
Everybody knows that I have a face for radio. I've got proof too. Take a look at this segment from my weekly radio show. So how can we help you, Frank?
The question I have, Rick, is regarding the required minimum distribution of an IRA.
Okay.
And the questions are, when in the year or how often in a year should I take the required minimum distribution, whether it should be annually, semi-annually, quarterly, monthly, which is almost the reverse of dollar cost averaging in.
That's a really great question, Frank. Let's first back up a little bit, make sure everybody knows what we're talking about. Brandon, explain what the RMD is.
Rick, it stands for Required Minimum Distribution. And when you hit the age of 70 and a half, you have to start withdrawing from your retirement accounts. In that first year, you can technically defer it to the following year, but generally speaking, everybody has to start taking out a set amount of money each calendar year.
Frank, how old are you?
I'm 72.
And the question becomes, do I do it in one lump sum once a year, or do I do it every month? Do I do it every quarter? What is, Brandon, how should he do it?
Frank, the frequency doesn't matter. The rule states that you have to take a certain amount out in this calendar year. And so you've got to take that amount out before December 31st of this year. The frequency is completely up to you. So if you don't...
From an IRS perspective.
Absolutely. So they don't care. So it's really based more on what your needs, your goals are. If you don't, do you plan to spend any of this money, or is this more of an inconvenience that you're being forced to make the distribution?
It's an inconvenience.
This is really interesting because in Frank's case, he is one of two kinds of cases. Some people need the income. So they need to take the money in January because they need to live on the money all year long. And for them, we would sometimes just tell them to take the money on a monthly basis over the course of the year since they need monthly income. Frank's case is, I think, more common, where people are recognizing they don't want the money, they don't want the distribution, they're only doing it, as you pointed out, Brandon, because the IRS is forcing them to do it. So Frank is just going to move money from one bucket to another, from the IRA bucket to a non-IRA bucket. And since you're going to do that, Frank, it probably doesn't make a whole heck of a lot of difference of when you do this because it'll all even itself out. The key is consistency. As long as you are doing it the same way every year, in other words, a single distribution every January, or a quarterly distribution every 3 months, or a monthly distribution, as long as you're consistent, you'll smooth out the volatility, which is your primary concern, as you pointed out, something known as a reverse dollar cost averaging, where instead of making monthly contributions in, you're making monthly withdrawals out. So as long as you maintain consistency, you're going to minimize the downside of the distribution from a tax perspective and maximize the ability to have the account maintain its value.
Okay, I guess I'm asking you to put your, to have a prediction of where you think the market's going.
Frank, you're asking Rick, is the market going to be higher or lower in the last couple weeks of the year?
I will guarantee to you, Frank, that no matter when you withdraw the money, the market will rise the day after.
Okay.
So, that's the way it is. It's Murphy's Law. So don't worry about it. You've been accumulating this money for many, many decades, and whether you do it today or a month from now, and whether the price is higher or lower, it's a whole lot higher than when you first invested the money, isn't it?
Yes, it is.
Let's call it a day.
Okay, thank you, Rick.
Sure thing, Frank. Thank you so much for calling.
Of today's 65-year-olds, 50% will require long-term care at some point.
My question is, what advice would you give a couple nearing retirement in a underwater mortgage? How can we cut our losses?
Are you able to afford the current mortgage payment?
Yes.
You are. And are you satisfied living where you're living?
No.
Not really.
Not really.
But is it acceptable to you, or?
It's acceptable. We would like to leave here within 5 years, but yeah.
But you would do so if you could afford to. In other words, if it wasn't for the
we would leave here
economics,
next year if we could afford it.
If you could afford to move, you would do so in 5 years.
Next year.
Next year, you would do this. Are you working at this point?
My husband works.
Your husband works. And when does he plan to retire?
Well, We wanted to leave Virginia by next year, but we're in such underwater mortgage that we think we need to stick around.
And when you leave, why are you leaving, first of all?
We prefer to live somewhere else.
Let me ask you this. What's the value of the house?
I mean, it's gone down into the 200s.
250?
Yeah.
Okay. And,
and we paid $5.
And what's the mortgage balance?
$500. We paid $500. We put $50 down.
So the original mortgage balance was $450,000.
Right.
That was about 4 years ago.
That was about 4 years
ago.
ago.
So the current mortgage balance is probably about $443,000.
That sounds about right.
And the house's value, you figure, might only be $250,000 to $300,000. So you're underwater $150,000 perhaps.
Yes.
If you were to move, into what type of housing would you move to? Is it your preference to buy something next, or are you willing to rent where you go next?
We've always prided ourselves in being homeowners.
Okay. That, by the way, has been one of the biggest frauds of American politics, is tricking people into thinking that the American dream is homeownership. And that is what has caused the mess that so many Americans are now in, because they were pushed by society, everybody in society, from the politicians to the real estate industry to the mortgage industry to the investment community to parents and the social circle, to buy a home, and that if you don't own a home, then you're somehow inferior. As awful lot of folks are now discovering, that didn't work out so well. So what I would encourage you to do is to forget about the ideas of home ownership when you leave here and go to the next place. What you want to consider, and you need to meet with a financial advisor to go into this in greater detail, consider the idea of walking away, of engaging in something that is known as a short sale, where you get your lender to agree to allow you to sell the house for its current value of, say, $250,000. And even though you owe the lender $450,000, the lender says, you don't have to pay us the difference. So you sell the house for whatever you sell it for, and we'll forgive the rest. Congress actually passed a law making it easy for you to do that without any adverse tax consequences, which there used to be. So your lender may very well cooperate in this effort, because they'd rather have somebody living in the house than having it abandoned and empty. So talk with your lender about a short sale, which allows you to sell the house for whatever you can sell it for, and you move on. And when you do move on, abandon notions of immediately becoming another owner. Instead, maintain liquidity, flexibility to just get yourself situated, minimizing your expenses, maximizing your income, so that you can rebuild your lives from here on out. And if homeownership works in the future, then fine, but don't be in a terrible hurry to do it. So first step, talk to your lender about a short sale and see if they're willing to cooperate. I think maybe they will be.
Thank you.
I'm happy to welcome to the program the Duke of Divorce, Dr. Estrangedlove. Yes, it's celebrity divorce lawyer Raoul Felder. He's here to share with us some of what he's learned over the years from handling some of the biggest profile divorce cases. Raoul joins us today from his office in New York City. Raoul, thanks so much for joining us on The Truth About Money.
Thank you, Rick.
Raoul, first and foremost, is divorce an emotional issue or a financial one?
Divorce is an emotional, it is a financial problem, it's a psychiatric problem, it's everything that ever went wrong in your life facing you.
Raoul, what do you say to someone who approaches you for the first time as a new client, and they say that, hey, I've been married for 10 or 15 or 20 years and my spouse doesn't treat me badly, they're not abusive, but I'm just not in love with them anymore. What do you say to that?
Well, Rick, what's love? A lot of cynics would say it's what you do in the back seats of a car when you're 18. Divorce is a very expensive game. I think it's fair to say that today litigation generally is expensive. Litigation is not for individuals. Litigation is for companies and businesses. However, in divorce, it has to be a one-on-one, like an automobile accident. So that chews up lots of money. And it's quite true, even being a lawyer, a divorce lawyer, that the only people often who make the money in the divorce case are the lawyers. And it's not that they're cheating or stealing or doing anything like that. The problem is it's a labor-intensive situation for a lawyer, and it's fueled by hatred, disinterest, mistrust, all these good stuffs of life. And so it's self-perpetuating, it's generating, and it takes much longer than it should ever take.
So when someone is contemplating divorce, what are the things that they ought to be thinking about? What matters?
Most people, except the very rich, the average citizen, and maybe upper middle class, has to understand that when they split up, neither one of them is going to be living the way they used to live. And that's very important. Now, the unfairness is that one of the couple, it's usually the man, is able to regenerate his life and start earning more money and live a normal life. The other one, it's usually the wife, according to the studies, her standard of living decreases as much as 30%. That's concomitant with the average increase in the ex-husband, of about 30%.
There's no question that divorce is bad enough, but it gets even worse when there are children involved, especially minor children. And recent studies have just shown that parents who have divorced contribute less to college educations for their children than parents who don't divorce. Can you comment on your experience regarding that?
They got to sit down and see how do the kids impact upon this, because the victims, the collateral damage may be a better word. The collateral damage of divorce is the children, and they're the effects of very strong and definite, and everybody realizes that. But you got to think out, how are they going to be educated? If we move, where are they going to be educated? What if the guy, the ex-husband who's paying the money, dies or becomes incapacitated? Well, what's going to happen at that point? Now you're talking about college. The trouble is there's just not enough money to spread it around. So when the education bills come in, and they're staggering, and I'm not even talking about private school, which in many communities is an accepted fact of life. You're talking about today $35,000 in private school, and some upward of that.
Raoul, you've been in this line of work for decades now. What is it you've learned about human nature?
For the most part in human nature, Rick, what I learned is there's not a good or bad, except in very limited cases. People are people, and lawyers should be judgmental. But people are not evil or good. They act like people, and they have warts, and they do stupid things in private, and you deal with it. And the other thing is, there's much to be said for moving on, to coming to a conclusion, not to fight over grandma's heirlooms or money or anything like that. You got to move on. The one quantity that's very limited to everybody is life. And you're making a bad trade. You're trading money or aggravation or the opportunity to torture a spouse for part of your life, and it's a bad trade.
Raoul Felder, divorce attorney extraordinaire, thanks so much for joining us on The Truth About Money.
Thank you, Rick.
And if you'd like to watch more of our interview with Raoul, just go to our website, truthaboutmoneytv.com, for more information there. And now, before we go, how would you like to spend an extra $5,000 in taxes for no reason? Well, all you need to do is hire an unlicensed tax preparer. The Treasury Department's Inspector General says that 6 out of 10 tax returns that are prepared by unlicensed tax preparers are done wrong. In one case, a taxpayer paid nearly $5,000 more than required. Don't do taxes yourself, and don't ask your neighbor or son-in-law to do it for you. Instead, hire a professional. And that's the truth about money. I'm Ric Edelman. Thanks for being with us.